I'd like to welcome everyone to the first of 3 webinars addressing inflation and interest rates. My name is Joanna Truitt, Executive Director for the Association Education Alliance, of which your company is a member through your association membership. And on the next slide, we'll see all of those associations who are participating in this webinar series. All of these associations that you see here are members of AEA, which is a consortium of distribution-based trade associations. Before we start with the introductions, just one quick housekeeping note. If you have any questions throughout Alex's presentation, please feel free to enter them into the Q&A section. We've left plenty of time at the end of his presentation to ensure that we can address all of them. So without further ado, I would like to go ahead and introduce Alex, who is our presenter for this webinar series. He is a highly experienced market researcher and analyst with more than 20 years experience across subjects, including economics, industrial manufacturing, automation, and advanced technology trends. For the last 2 decades, he has consulted and advised companies throughout the US and Canada, Europe, South America, and Asia. He is currently overseeing a suite of analytics products focused on talent for Miller Resource Group. He is also consulting with companies to help them become better at attracting, hiring, and retaining the impact players for their industry. Again, most of you are familiar with Alex and know exactly the type of research that he does and the value of the information that he presents. So Alex, we'd like to go ahead and turn it over to you.
Thank you so much, Joanna. It's a genuine pleasure for me to be back in front of the AEA audience. And I want to take this opportunity to say thank you to all of you that are taking time out of your busy days to educate yourself, to stay up to date on what's going on in the world and in the economy, and really to connect the dots between that economic information and what you should be thinking about, what you should be doing as business leaders in order to have the best outcomes and the best performance for your own individual organizations. I think it's been safe to say for a while now that we are going through some very uncertain times right now. There's a lot of questions about the path of the US economy as we look to the future. And so I thought that I start our session today by taking kind of a very large 50,000-foot view of what's going on at the global stage. So here you can see in this very interesting graphic from the source Visual Capitalist. If you're not familiar with Visual Capitalist, I highly recommend you check them out. They have some fantastic ways to visualize data of all types. But this particular graphic shows where the world economy was at the end of 2022. You can see very clearly that the United States remains firmly positioned at the top of the global economy. China is in second place, but a fairly distant second place still, about 25% smaller than the US economy. And then we have the rest of the global footprint of the large and significant players that actually move the needle when it comes to economic production and contribution on the global level. So you can see Japan, a lot of the major Western European countries like Germany, UK, France, and Italy. India is part of the mix, as well as Canada and Brazil. That rounds out the top 10. What you will notice is that despite their disproportionate share of news coverage, Russia is nowhere to be found in this particular list. You'll see it at the very bottom of the screen here. $1.8 trillion means that the Russian economy is less than 10% the size of the US. And by the way, it's also smaller than just the economy of the city of New York. So I want you to understand that a lot of times what you listen to in the media coverage, what you read about online is designed to push forward a specific narrative by various parties, both on the left and the right side of the aisle. And I want to continue to challenge you as decision makers, as business leaders, that you need to try to take a step back from all of that. You need to be data driven in your decision making. I've advocated for that approach for a very long time now. And so that's what I hope to do for you today, is to talk a little bit about the data, help you make sense of what's going on, and really, again, connect it to actionable, practical things that you can do within your business. So as we look at the global economy, it's very easy to fall into kind of a state of malaise based on all the negativity that exists out there. And certainly there's been a lot going on. So if we look back at 2022, massive amount of different COVID variants, a surge in inflationary pressure, a corresponding rise in interest rate policy by the Fed. We'll talk about that later on. And as of course, many of you know firsthand, critical supply chain issues impacting your ability to deliver products to your customers. Oh, and by the way, there's also a significant war going on in Ukraine, of course, with Russia invading the country for various reasons, but essentially it's become kind of a de facto conflict between the West and Russian aggression. And so all of those things going on, you'd think on paper that would have a substantial negative impact on economic output globally. And the reality is it really didn't. I mean, it had an effect, but we still had a record high economic output for the year as a whole. You can see the global economy was at $104 trillion at the end of 2022. And it's a reminder that the natural state of free market economies overall is one of growth. We have a growing global population that fuels consumerism and the consumption of various products and services, and that means more and more economic activity. What it also alludes to is that when we have periods of recession, like the one that we had in 2020 during the COVID pandemic, like the 2008-2009 financial crisis, the 2000-2001 downturn that was the result of the tech bubble bursting, and even further back, the 80s with the oil embargo. Most of those recessions are, first of all, part of a normal economic cycle, but second of all, a lot of times they have to do with something that we do to get in our own way as a global economy. And that's certainly true today. What we see going on at the Federal Open Market Committee level, the body that sets interest rate policy in the United States, is in order to bring inflation back under control and in order to cool a job market where there's a disproportionate gap between the amount of people looking for work and the amount of people available to work, they are cooling the economy on purpose through higher interest rates. And that I've affectionately started calling the reselftion, because it's essentially something that we are doing knowingly that it's going to constrict economic activity. So what's happening in the economy today, I think, is a reflection of our own actions rather than something broken fundamentally in the system. So when we zoom in on the United States economy, I think it's very evident that it's important to look at the data in a couple of different ways. So the first way that I'm looking at the US economy is by taking a look at US real GDP. And this is basically the top line value of all economic activity in the United States, measured in dollars that are chained to levels of 2012. And what you can see is that we have data through Q4 of 2022 right now. And that data shows that the US economy at the end of 2022 was at a record high territory. So not only have we clearly recovered from the pandemic contraction that we experienced in Q2 of 2020 and in Q3 of 2020, as you can see here, the downward movement, we are beyond that and in a record high position. So at face value, it's looking pretty good. But I always say that it's important to look beyond the face value. And in this case, I'll give you the analogy of a human being. Someone's outward appearance, their outfit, their facial expression, how their hair is styled, is only part of the narrative. It's only part of the total understanding of what that person represents. In order to really get the full picture, you have to look internally as well. You have to measure the vital signs. You have to get their heart rate and blood pressure and cholesterol levels. So someone might look really good on the outside, but internally, you know something is wrong. And that's what we're seeing when we look at the same data for US real GDP, but instead of looking at the actual dollars associated with economic activity, we're looking at the growth rate. So this chart here shows you the annual change in real GDP when we compare essentially one quarter to the same quarter from last year. We're talking about a quarter-over-quarter growth plotted over time. And what you can see here is that, yes, absolutely, we had a very strong rebound from the pandemic downturn. But since a peak in 2022, we've been decelerating on a business cycle basis in the US economy. And where we are today, or at least through the fourth quarter of last year, was essentially on par with the pre-pandemic norm. We're growing by a couple of percent over time, and that's reflective of a relatively stable expansion in US economic activity. But at the same time, the fact that we are decelerating here clearly shows that things are not as rosy as they were in early 2022. We are growing at a much slower pace today than we were a year ago. So when we dig in a little bit deeper here, I think it's important to identify two things. Number one, you'll often hear the term recession thrown around, and when people say that, they could mean different things. For example, if you'll recall, in the first half of 2022, during particularly the first quarter and the second quarter, there was this talk of, are we in recession right now? Because some people were pointing to the technical definition of recession, which of course has to do with consecutive negative growth in GDP for 2 quarters in a row. So as you can see here, we did have that happen. Q1 in 2022 was negative to the tune of almost 2%. But again, looking at the details here, what you'll observe is that this actually has to do with a part of the economy that doesn't accurately represent what's going on. This is dealing with trade. And so what happened in Q1 is we actually imported a lot more than we exported. So our trade deficit was robust enough to offset domestic expansion in the economy, meaning that the math associated with GDP performance came in negative year over year. In the second quarter, we had a bit of an inventory destocking trend emerge. And so once again, very minor negativity here, but it was negative nonetheless. And so people would say that technically that qualifies for the definition of a recession. But the reality, in my opinion at least, is it did not feel like or was a recession. And in fact, the National Economic Bureau of Research, they agree with me because they typically call recessions based on a preponderance of factors, not just 2 consecutive quarters of contraction. And they also do so retroactively. So once the recession has started and is on its way, they'll usually say, okay, we are now in recession. They did not do that for the first half of 2022. And therefore, it is fairly safe to say that we did not actually go through a recession at that time. The other element that I want you to understand here is how the US economy breaks down, because there are a few key elements that drive economic activity in this country. On the right-hand side of the chart, you can see there's a pie chart with the largest by far component coming from a segment called personal consumption expenditures. So this is about 69% of the overall pie, and it reflects the money that you and I spend on going out to restaurants and seeing plays and buying clothing and furniture and electronics and cars, and all of the things that we consume in our day-to-day lives have to do with that blue pie piece. And so it is fair to say, in my opinion, that the US consumer, you and I, individuals combined altogether in one massive consumption force, we are the main growth engine of US economic activity. Now, there are a couple of other important components, and you can see them here in the green and the yellow. Green represents spending by the US government in various facets, both at the local level, at the state level, and at the federal level. And you can see that accounts for just under 17% of overall economic activity. The yellow pie chart here represents gross private domestic investment. That's a complicated term for business-to-business spending and CapEx, essentially. So when businesses invest in growth, in expansion in their own industry, launching new products and services, that's where it gets captured. And it's also, roughly speaking, 18% of the pie. So together, these two categories, let's call it 44%, or I'm sorry, 42%, sorry, 32% relative to the 68.5% here. But clearly, they take a backseat to the personal consumption expenditures. So as we try to ascertain what the future holds for the US economy, and if we are in fact headed for a recession, one of the main issues that we have to address is that we have to ask what is going on with that consumer spending category. And a great way of doing that is by looking at a data series called retail sales. In this particular case, it's a all-encompassing series, including trade and food services. And you can see this is a pretty significant data stream. $8 trillion, north of 8 trillion, in fact, as of the latest reading. And you can also see how uncharacteristic the last 2 years since the pandemic have been. The rebound in demand has been so strong and sustained for quite a long period of time, to where we see that when we look at the dollars that are actually being spent versus the trend line of what one would normally expect to be spent, we are in a whole new territory. So as you can see, this red dotted line postulates what it would be kind of typically expected, if not for the pandemic rebound and surge in demand, and where we actually are. So these are the dollars. You can see 8 trillion overall associated with retail activity. The same data series, but looking at the vital signs, as I mentioned earlier, shows, again, a different story. So this is the growth rate associated with retail trade, both in terms of the shorter term, so quarter over quarter, and the longer term, that's the year over year. And what you can see here is that both of these rates of change are moving down and doing so quite consistently over time. So we are well past the post-pandemic peak, which occurred once again in 2022, and that has been declining now for the better part of a year. The other thing that we can interpret from this graph is because the shorter term growth rate, this white line, remains firmly below the orange line, that suggests to us that over the next 2 quarters, this annual rate of change is going to continue to move downward, because that white line is going to act as an anchor, as a weight on that annual rate of change, pulling it down over the next 3 to 6 months. So we have further deceleration based on just the simple dynamics of the data internal trends as we observe them here with the rates of change. So it's to be expected. We were never going to grow at an accelerating rate forever. But what is the impact to our ability to spend money as we look out towards the second half of 2023 and certainly into 2024? Well, in order to gauge that with some degree of accuracy, we have to look at what our debt situation is. And so here, I wanted to give you a quick sense of where we owe our money. And once again, it's a story of a large part of the chunk accounts for the significant portion of our overall debt, and that's this green area, which represents mortgages, the primarily 30-year mortgages, in fact. There's also this light dark blue area here, another 2% of the pie that represents home equity lines of credit. So you can safely say that about 72.5% of total American consumer debt is tied up in the property market, whether it's single family, multifamily, in mortgages of all types. And that's good news, because the vast majority of that debt until recently was financed at a very, very low rate. In fact, the average 30-year mortgage rate of people who hold the debt today is somewhere between 3 and 4%. Now, there are obviously higher rates that we've seen over the last year. Currently, I believe we're right around the 6.5% mark on the 30-year mortgage, but the vast majority of this debt is very much, at an interest rate that is sustainable and that people have the ability to make consistent ongoing payments on. So I'm not worried about the mortgage side of the equation. Now, when we look at the other categories, some of them are more concerning. I'm not currently concerned about student loans. Now, that's largely because of the moratorium on payments and defaults that has been, pushed forward and enacted by the U.S. government. At some point soon, that moratorium is likely to run out, and then we're going to have to look very carefully about what happens with people's ability to pay on that student debt, particularly the individuals that have variable interest rates and are going to be paying much higher rate of interest on the loans that they have outstanding. But at least for now, that student loan component is not a concern for me. Where I am seeing some concern and where I'm seeing some red flags are the orange and the light blue areas of this chart, which is the auto loan sector and the credit card sector. Both of those typically fluctuate substantially with interest rate policy changes. Both of those tend to be shorter term interest rate type of environment. So most auto loans are somewhere between 5, 6, maybe upwards of 7 years. And so there's a lot of turnover. It's not like a 30-year mortgage. So overall, auto loans account for less than 10% of the debt. So it's not going to be critical, but we are seeing some very worrying signs. For example, Gen Z auto buyers on average now have a monthly car payment of $1,000 a month. And that's really, by even my standards, something that's hard for me to understand, because I'm still living in the day of, it's typical for you to have somewhere between $300 and $500 a month going towards an auto loan payment. And if you're paying $1,000 a month, that's a much heavier burden to carry, particularly if you're in the early stages of your career and are not making as much money as you would in the middle to later stages of your career. The credit card situation is also quite concerning, because most of those rates are variable and are fairly consistently now over 20%. So unless people are able to pay off their credit card bills in full every single month, it's going to be very expensive for them to carry that debt. And it's very easy to see how somebody might fall into a trap of accruing all of that interest and not being able to pay off their balance for a long period of time. So now that we understand where the vulnerabilities lie, let's actually look at what the data says about people's ability to pay that debt. And the way that we do that is by looking at delinquency rates. In this particular case, I'm looking at 30+ day delinquency rates by loan type. And you can see that there's really not anything at this point in time that is overly concerning. So the student loan moratorium, as you can see here, has caused essentially a flatlining of that delinquency at very, very low levels. If you look at mortgages, which is this kind of brownish line, also very low, just over 2%. Now, it is mildly rising, but even where it stands today is substantially below the pre-pandemic norm. So I'm not worried about mortgages, and I'm not worried about home equity lines of credit. Where I am starting to get worried about is auto loans and credit card debt. So you can see these are rising at a sharper pace relative to mortgages. And although they're not in problem territory yet, you can see where we were related to those delinquency rates back in 2008, 2009, for example, north of 10% in both categories. We're not anywhere there yet, but that rising trend is concerning. So we have to continue to pay attention to that as new data comes out month after month. It's something that I'm going to be following very closely. And if it gets to a point of critical mass, I'll certainly make sure to let you know in future episodes of this series. But as of right now, when we look at people's propensity to be able to pay on their debts, we're not seeing any really big, scary kind of signs out there that things are staring, and looking to fall off a cliff in the immediate future. So with that in mind, let's take a look at the two key topics that we wanted to cover today, which is inflation and interest rates. Let's start with inflation. There are two different ways to measure inflation. One has to do with the way that you and I as consumers feel inflation, and the other one is how businesses feel inflation. So the first chart here has to do with the breakdown of where inflation stands today and its various components. You'll notice here that pre-pandemic, inflation was pretty benign, running at around 2%, most of the time even below 2%, which is the Fed's target for inflationary pressure as measured by the PCE, the Personal Consumption Expenditures in Inflationary Price Index. And you'll see that once we got into early 2021, so once the recovery from the shutdown of the pandemic really took hold, inflation started to rise very sharply and peaked around the midpoint of 2022 at over 9%. Now, where we stand today is a much better environment than where we were a year ago. So as of the latest reading, which just came out this week, inflation on a year-over-year basis for the Consumer Price Index is at 5% year over year. So we've essentially cut the inflationary picture in half. But again, the devil, as always, is in the details. And what we're seeing here is that by far the biggest contributor to inflationary pressure today is the core services sector, of which a major component is housing prices and rents. And so it is the cost of rent that's driving a lot of the inflationary pressure right now. Now, that tends to lag behind what's actually happening on the ground because people are still benefiting from their previous contracts that they signed in place. So as we get into the future, we should see that core services component start to come down, but it's going to take some time. So I'm encouraged by the fact that, for example, this month, energy actually went into negative territory for the first time since this rise in inflation began. I'm very encouraged by the fact that core goods inflation is basically zero now. I mean, it's very, very small. Food inflation is still a part of the conversation, but it is shrinking over time. You can see it was a much bigger piece of the total a few months ago, 6 to 9 months ago, than it is today. And if we can start to see some of that decline continue, you can see we ticked down in the month of March from where we were in February. So if we can see that core services inflation component, which of course, again, represents rents and mortgages, the cost of housing, is going to continue to come down, we'll be in much better shape come the end of the year, and certainly as we traverse 2024 as well. So that's encouraging from the perspective of the Fed will not have to pull that interest rate raising lever nearly as hard, where they can see that inflationary pressure is receding and that there's really one particular component that they can actually help by lowering interest rates, which of course drive a lot of costs in both rents and the cost of housing overall. So encouraging signs from the inflationary landscape for individual consumers. We also see very encouraging data in the producer price index. The fresh data for this came out just today, and you can see that year over year, PPI, or the producer price index, is now up just 2.7%. So if I were to draw a line here, we're essentially on par with PPI of 2018 and 2019. And this, of course, is critical because this is the way that businesses feel inflation. So in your own organization, we're essentially back to pre-pandemic levels of inflationary pressure, which is both a good thing, but it will also create some challenges that I'll talk about shortly. So inflation is coming down both for consumers and for businesses. That's great news, and it's certainly going to allow the Fed to take the foot off the pedal in terms of future interest rate hikes. In my personal opinion, I would not be surprised at all if we see them pause any additional hikes. Maybe we'll get another quarter, maybe half a percentage more, but the likelihood is that we're probably behind now the period of time when they were raising rates. They're going to be watching the economic data. They're going to be reading the tea leaves and really trying to decide, have we now done enough to cool inflation, to bring the job market back into alignment between supply and demand, or at least everything that we could do, and therefore we no longer have to raise interest rates any farther. There are also some great leading indicators, one of which I'm showing you here, which have some predictive ability about what inflation is going to do in the months to come. So if you look at the supply chain environment, for instance, it actually has about 3/4 worth of predictive ability relative to inflation. So the dark blue line here is the global supply chain index from the New York Fed. I'm plotting this as a 3-month moving total, and you can see the data actually exceeds the orange line, which is that consumer price index rate of change. And it says that we should see continued decline in that CPI as we go on through the rest of this year and into early 2024. So to summarize on the inflationary front, we're already seeing evidence that inflation is falling, and leading indicators suggest that it should fall further for the remainder of this year and into next year as well, which bodes really well for both consumers and businesses and the propensity for the Fed to not have to raise rates in the future. As we look at federal interest rate policy, they have given us guidance that they're pretty much in alignment with what I just told you. So this is essentially the dot plot that the Fed puts out after every meeting. This one was put out after their meeting at the end of March. And each dot here on this chart shows an individual voting member of the FOMC, or the body that sets interest rate policy. And you can see they're basically saying that the consensus of them believe that for 2023, interest rates are today where they will be at the end of the year. So that's indicative of the fact that they're not planning on raising rates farther from this level. Now, there are some outliers here. You can see At least 7 members of the committee said, yeah, we might need to raise rates a little bit more, maybe a quarter, maybe 0.5% more relative to where we stand today. There's at least one member that's acting in a little bit more dovish capacity and saying maybe we potentially cut rates at least once, but before the end of the year. But the general consensus is the period of raising rates is behind us. And as we look out towards 24 and 25, and certainly in the longer term, you can see they're spread out by a quite large margin, but the majority of the voting members here believe that we'll be about 0.5 to 1% lower on the federal funds rate by the end of 2024, and about 2% lower on the funds rate by the end of 2025. So they're actually projecting that they are expecting interest rate cuts in the next 12 to 24 months. Now, the timing of that is still very much TBD, but at least at this point, they're signaling that they are done raising rates and are going to be looking for evidence to support the desire to cut rates if they see the economy shutting down too much relative to what they're hoping to accomplish. Now, I don't want to get your hopes up, particularly for this year. This is a quote from Jerome Powell, obviously the Fed chair president. He said that they just don't see them cutting rates this year. My personal view is it's going to depend on the data. There's no sense in trying to time the specific month when they might actually cut rates. I think that if we see the leading indicators pan out in terms of the macro environment, that we do continue to slow and are likely headed for a recession by late this year and into 2024, then there's going to be impetus for them to pull that lever to lower interest rates, to soften the landing a little bit and not have the recession turn into something more severe and more prolonged. So that's a tool now that they have in their tool belt in order to try to navigate this difficult period over the next 12 to 18 months with some grace and hopefully to soften that landing. So with all of that having been said, I wanted to share with you this one last slide, and this is basically a survey that Bloomberg does of about 30 different economists from prominent financial institutions, including all of the major banks. And I think it's a good sense for the consensus opinion about what's happening. As of the March survey, you can see the expectations of a recession are at about 65% or 2/3. And so it's likely that we are heading towards a recession. The leading indicators that I track that I'll be sharing with you in future episodes confirm that we are likely going to see a recession, particularly on the industrial side of the economy, maybe not so much on the consumer side of the economy. But I want to put you at rest to say that it's not looking like it's going to be a severe downturn. Certainly nothing on par with either 2020 or 2008, 2009. Likely, we're looking at kind of a 2000, 2001 type of event. And that means, 3 to 4 quarters of mild contraction. But I've been saying this for a long time. I actually think that this is healthy for a US economy that was an absolute tear in 21 and 22. It might not feel great to see your numbers move down, but we need an opportunity to catch our breath a little bit. We need to see inflationary pressure continue to decline. We need to establish a rebalancing in the labor market so you're not struggling to find talent all the time. And if it takes a mild recession to get us there, then I think it's important that we brace for one, but also prepare ourselves for the next rising trend, which is likely going to emerge by late 24 into 2025, and it's going to be several years in length. So ask yourself, what is it that we did around the 2000-2001 period that we wish we had known in advance, and kind of start planning, start scenario modeling for what that looks like within your business. Because at this point, based on everything that I'm seeing in the data, that's the likeliest outcome. So I hope you found that interesting. I hope you found that useful. I want to make sure that before we wrap this up, I give you a few key elements of practical, actionable advice. And so here it is. The first thing that I would say is look for opportunities to maximize cash flow every chance you get, because the likelihood is that over the next 12 to 18 months, access to financing is going to be constrained and it's going to be very expensive. So there's really no good terms available because of where that federal funds rate is today. The other piece of advice that I would tell you is, in anticipation of this mild recession that I'm expecting, you should look for opportunities to lock in business. That might mean that you sign a 2-year contract with one of your customers instead of a typical 1-year contract, even if you are needing to give them a discount in order to incentivize that behavior. That will essentially soften the landing for you and kind of create a foundation upon which you can build as we emerge from this mild downturn. The last piece of advice I will give you is you really, really have to watch your profitability. With inflationary pressure coming down, it's going to be very difficult for you to get price increases across to your customers, certainly as it's relative to 2021 and 2022. So you're going to get some pushback, and you really have to look at your business, not just at the overall profitability level, but you have to look at it by customer and by product type. And you have to really say to yourself, can we afford to continue to do business with customers that aren't profitable for us? Can we afford to continue to invest resources into product lines and industries where we're not seeing the margins that we want? Of course, the answer to that question should be no, because you're in business to make a profit and not just to grow your top line sales. So even though it's going to be painful and emotionally draining for you to walk away, you've got to be willing to cut the losers, and you've got to focus on your bottom line to maintain that profitability as we go through the rest of 23 and into 2024. So with that, I will wrap it up and turn it back over to you, Joanna, to see if there are any questions from the audience.
We do. We have a couple of questions. The first, any word on yet on real GDP for first quarter of 23?
I tried not to guess with that, but based on what we saw from the early months of this year, I think it's going to come in mildly positive. I don't expect there to be a negative reading when the data comes out, but it's going to be very mild. I mean, essentially, you can think of it as almost flat. I think that it's kind of symbolic of where we are. That deceleration you saw, the latest reading was around 2% growth. I think that was for 2022 as a whole. I think that's going to continue to decelerate over the course of this year. So, and on an annualized basis, now keep in mind, there are different ways that you will read about the GDP print. Most of them are going to talk about comparing Q1 to Q4. To me, that doesn't really make a lot of sense. So you really have to think about Q1 of this year relative to Q1 of 2022. And in that sense, considering there is going to be a boost from still relatively high levels of inflation, I would imagine it's going to be a mild positive number when we see the Q1 year-over-year rate of change.
Okay. The next question, ITR is still forecasting the Great Recession in 2030s. What are your thoughts on this?
So this is a interesting question. I think that the messaging that ITR puts out regarding the 2030s Great Depression is correct, in the sense that you need to be positioned well for taking advantage of opportunities when they arise. Now, I, at this point, question the severity and the longevity of how bad they think the downturn is going to be. But I also think that it's still so far away that many, many different things can happen. I mean, we have a lot of positives going for us, even though we're staring into the brink of a mild recession right now. Just the beginning of this year and the advances in technology. I'm sure many of you have read countless articles about ChatGPT and generative AI and how that's going to change the world around us. Keep in mind, when you look at the 2030s, more than 75% of all the jobs of the 2030s haven't even been invented yet. And so it's very difficult to postulate that, there's going to be that level of calamity still, 7 to 8 years out into the future. So I think that I'm going to listen to the advice that ITR gives, which is, of course, be prepared, have money available to invest in opportunities when that does come. And of course, if you're looking to time all of that, whether it's a career end or an exit from a business, then you have to start paying attention much closer. So when we get to like 27, 28 timeframe, then I think it's going to be a lot easier to tell. But I think that prognosticating about something that's nearly a decade out at this point is not something that I'm looking to do. So I'll answer it that way.
Fair enough. Another question is, what is your outlook for petrochemical related price direction for ROY 23?
Yeah, so there are two forces at play here. Short term, we obviously have a major production cut by OPEC announced recently. We've seen prices trend upward over the last 3 weeks or so. I believe we're around $83 a barrel on the WTI price right now. I think that that constraint is likely going to be felt in the short term. Longer term, I will even say medium to long term, I think that the pressure is going to likely be to the downside, particularly if the macroeconomic environment deteriorates the way that I expect it to, based on the input from various leading economic indicators. So I think that the big picture, the mega trend, the forces from the macroeconomy are saying that there's going to be less demand as economic activity cools, but I don't see prices going to north of $100 a barrel, for example, unless there's some sort of calamity, related to the war in Ukraine or some other geopolitical event. I also don't see prices going down substantially. I think that if we're able to manage, the soft landing that I think is still possible, given the ability of the Fed to lower rates if they need to stimulate economic activity, I would guess that the general trend line, and I'm not forecasting the price of oil, but my gut tells me somewhere between $60 to $80 a barrel by the end of the year.
Another question is thoughts on BTFP. Did the Fed pivot quietly?
Well, so there's plenty of historic evidence that the Fed has the ability and the willingness to pause rate hikes, even though they're guiding for potential increases in the future. And so I think that, again, looking at their future guidance from the dot plot chart, looking at the latest data as it's come in, I pay attention to the main things that they say are the driving factors in their decision making. So if we look at the labor market, for example, we had a decline in number of job openings with the latest data read. We're now at 9.9 million versus like 10.8 million last month, so a pretty substantial pullback there. We had fewer jobs added in the month of March. We were at about 235,000 relative to about 300,000 the month before and about 470,000 in January. So we see evidence of a labor market that's turning over, that's cooling. It's not aligned by any means yet, but it is in the process of doing so. We see evidence of the other metric, which is the inflationary pressure, also cooling. And so I think that it is fair to say that they could have very easily decided, okay, at this point, we're going to adapt a wait and see type of approach. And if you read the meetings of the notes of the last FOMC meeting, there's actually quite a few voting members that were expressing concern about the recession, because the data research team at the FOMC, the analysts essentially that are providing input to the decision makers, they were saying, it's likely looking like a recession. And so there's that concern. And so I think that there is going to be a propensity for them to not break things too much. Therefore, they could have fairly quietly decided to pivot into at least a no more rate hikes at this point. I don't think they've committed to cuts, but certainly in terms of expectation of future rate increases, I just don't think that they're going to be looking to be aggressive on that anymore.
We'll do 2 more questions, and then we'll have to end the program. But the one question is kind of interesting. It relates to the forecast for commodities like gold, silver, and copper. What are your thoughts about crypto as a hedge against declining dollars?
Boy, I could talk about this topic for a long time. So I think that crypto itself remains still today a highly speculative asset. I don't think that I'm in the camp that says it doesn't have any value or is somehow a scam. We've seen obviously Bitcoin rally. We're now above 30,000 per Bitcoin, I believe, and that's the highest level since I think more than a year. We touched a low of around 16,000, I think, not just a few months ago. So there is a resiliency in crypto as an asset class. Ethereum would qualify as well. Litecoin, I obviously would advocate that you stay away from the meme coins, Dogecoin, Shiba, and so on. But at least the major cryptocurrencies are reflective of there's still a lot of cash swirling out there. There's still a risk-on attitude, unless there are specific reasons why people want to flee to things like bonds, which, of course, unless you're expecting significant interest rate cuts you're not likely to do. So I think it's an interesting play. I will caution, of course, be very careful with this because there is a possibility that it's going to disappear overnight. Personally, less than 1% of any investable assets that I have, that's going to be my cap. But I do like to be part of something that is revolutionary and new because I believe that there are ample justifications and rationalizations for why the blockchain technology that's behind crypto has a lot of different use cases. And most of them involve cutting out middlemen and really saving and connecting clients to providers, whether it's in insurance, whether it's in mortgages, whether it's in any kind of asset class that you can kind of digitize ownership of anything. I think there's a lot of sense. A great example is the money transfer industry. I mean, we're talking about trillions of dollars that people that earn money here in the United States typically send overseas. And right now, the best way for them to do that is Western Union, who charges 7% of every transaction, and the money takes 2 weeks to arrive, particularly to some third world countries. With cryptocurrency, the exchange of value is immediate. And so to me, I focus not on speculating in terms of it going to the moon, as crypto enthusiasts would say, but rather on the viability of using it for transactions and removing excess from deals that do not require a middleman. So I think that there's enough there to substantiate a very small play in the investment portfolio, but again, I'm never going to put more than 1% of my money into it.
Awesome. Well, we have run out of time for our program today. Alex, I'd like to thank you very much for the great information you provided. And I'd also like to say thank you for all of those on the call for your participation and your great questions. Tomorrow, your associations will be receiving a link to the recording of this webinar, as well as a PDF of Alex's presentation. So if you missed anything or wanted to go back and listen to some of the great information and advice Alex has given, you can definitely do that. We hope you do plan on joining us Wednesday, May 10th for the second webinar in the series, Macroeconomics 2, Commodity and Input Prices. So until then, take care. And we look forward to seeing you back on Wednesday, May 10th. Thank you.
Take care, everybody. Bye-bye.